So we're going to talk back about the markets now. This is a technique originally developed by Henry Wheeler Chase called market structure. I've made some adaptations and changes to it. A lot of you that know me have used this yourselves. There is structure to the marketplace. There's a way you can understand virtually every trend of the market, short-term or long-term in the marketplace. So a short-term day, a short-term low is a day that has higher lows on both sides of it. I'm going to diagram this on the board for us. Take a look at it so you can see what it actually looks like on your chart. It's very, very simple. If markets are coming down, we have a down day, a down day, a down day, and now we have a day that gets above the prior day's high. That is a short-term low. It may not last for more than a day. We don't know that, but it is a short-term low. We can absolutely positively say that is a short-term low. The market went from here down to there, and it came back up, and getting above that day's high says that's a short-term low. And that short-term low may continue for a long time. It may go up and up and up, but one day it will take out the prior bar's low, and that makes that a short-term high in the marketplace. So we can actually measure these swings in the market by just looking at determination of a trend move in the market. Short-term low, short-term high. We can do that. Now we'll take a look at a chart understanding that. So a short-term high will be a day that has lower highs on both sides and a lower low. We can identify that, absolutely identify it. Easy to do. In fact, we can look at it on a chart now. You can see I've marked off with a red line in Pfizer all of the short-term highs and lows in the marketplace. So here's a day with a higher low on it over higher high over here. So that's a short-term low. Oh, we take out that day's low, short-term high. We take out this day's high, that's a short-term low. Short-term, we take out that bar's low, and those are the short-term swings of the marketplace. I know, it doesn't sound like much to you yet, but there's a lot of information there. Tremendous amount of information once you start to look at it. First of all, at this point over here, I know the short-term trend of the market is down. Absolutely know that. How do I know that? Because this short-term move is less than the long-term move. This rally didn't rally as much as the market declined. I know the short-term move is up here because the down move is less than the up move. See that? So I don't want to sell short here. I want to sell short over here because if I take out that bar's low, I know I'm in a down phase in the marketplace. I want to be a buyer here because getting above this bar's high says the short-term trend in the market is to the upside. I can sell over here because we're making a lower high here than here. I'm selling short there. Suddenly, market structure starts to have meaning to it. I know the trend of the market. That was short-term high, but what if I have a short-term high with lower short-term highs on both sides of it? So what if I have a short-term high with lower highs on both sides of it? That's an intermediate-term high. And now if I look at that as an intermediate-term high, an intermediate-term low would be a low with higher lows on both sides of it. So I know this is an intermediate-term up move. And I have a high over here with lower highs on both sides. That's an intermediate-term high. So if I have an intermediate-term high lower than the prior intermediate-term high, the intermediate-term trend is down. I know that exactly when I take out this bar's low right here. No computer, no mathematics, no moving averages. Market structure tells me, oh, intermediate term trend is to the downside. I can sell short at that point. For an intermediate term down, and the nice thing is, if I sell short there, my stop is 1 day's range. Pretty close compared to hopefully a big intermediate term move to the downside. Intriguingly enough, if you were to run a moving average through there, would it probably be a flat line, maybe a little down, maybe a little up. Moving averages don't show us market structure. This formation, this nesting of short-term lows to intermediate-term lows to long-term highs and lows, that's market structure that shows us the trend of the market. The real trend of the market is the building blocks that we look at with market structure. So you see where I've marked off the formation of the short-term highs and lows. There's the intermediate trends of the marketplace, the blue line. Because I have a short-term low with higher lows on both sides, short-term highs, lower highs on both sides. So I know I can be a short seller right here because this intermediate up is less than the intermediate down, and I should move to the downside now. That's about all we used to trade with. Please.
How many different trigger points would you have there? Because we see a downward trend, we have a high, low, high. Are you waiting for like the third signal?
No, that's all very, very mechanical. We're in a downtrend. We don't know anything over here, right? So short-term sell signal, the market comes down, gets above this bar's high, so I go, oh, I have a short-term low. Above that short-term low, I know that's an intermediate-term point. You may get a succession of lower highs, lower highs, lower highs, but eventually you will have that formation take place. It will happen. Without a doubt, it will happen. Usually it's 4, 5, 6, 7, but sometimes go on a long time period. So that tells me where my short-term and intermediate-term highs and lows are in the marketplace. And we know it here, and we know the trend of the market just looking at short-term swings in the marketplace. But if we have an intermediate-term high with lower intermediate-term highs on both sides of it, we have a long-term market high. An intermediate-term low with higher intermediate-term lows on both sides of it is a long-term low. This is an intermediate-term high here. So that's we have intermediate-term highs with lower highs on both sides. We know the long-term trend at this point confirms the long-term trend is also to the downside. This all nests together. So we have all these little short-term things in the market like this. We can connect those with the intermediate terms, short-term high, short-term low, like this, like that. And then on top of those, we can bring in, this is a long term because it has lower intermediate term lows on both highs on both sides, so we know what the long-term trend of the market is. So we get short-term, intermediate term, and long-term all from market structure. And you'll know when the tipping point is over here, oh, there's an intermediate term high, lower highs on both sides, I can sell short there. I could have been a buyer here because they're higher here than here. Long-term trend at that point is up. So market structure really tells you the trend without any math. And that's where the mathematicians get confused. They run front-end weighted exponential moving averages looking at all this data and they go, oh, the trend is flat. No, it's not flat. The trend is down big time right here, right now. But they don't see that mathematically, but we see it with market structure. I'm sorry? Sure, it works on any time frame. But again, 15-minute charts, it's an easier way to make money. 15-minute charts are high-hanging fruit. You climb up that 15-minute chart tree, it's a long way down. I like the low-hanging fruit of 20% a year or intermediate-term trading like we're getting into now. That's the easier trading. So now here's another thing we can do. If I'm selling short here, I need a target in the marketplace. Where's my target? Well, if I take out this point, that's an intermediate-term low, I believe that I will decline as much as I rallied above this point, decline down there. That will be my target. And that has been a great target, not an original idea of mine. George Siemens wrote about it in the 1948 time period. I've used it many, many years. Here it is at work. We have a short-term high here. Market pulls down. It gets above that high, so it should rally as much as it declined above. There's your target. We rally here. We close trade below it. Our target to the downside is here. You can use these short-term targets to enter, and I'm sorry, not to enter, but to take your profits, to exit your trades. Here we have a nice little short-term high over here, short-term low. We took out that low. We're going to take that distance, subtract what we got out there. Got out a little early. That'll happen sometimes. Most of the times, though, you're going to be getting out pretty close to the absolute highs and lows in a marketplace. It's been a great technique to use for short-term or even intermediate-term targets in the marketplace. My all-time favorite story, I was in Chicago running the Chicago Marathon when we used to trade pork bellies. And after the marathon, we went out for dinner. One of the guy's wives was the largest belly trader in the pit. And I'm short bellies. And I'm really close to a target. I said, what do you think about it? Oh, they were locked limit down. He said, they'll limit down another 3 or 4 days. And this guy must know pork bellies because he's a Jewish guy trading pork bellies. So I'm really listening to him about pork bellies, right? Limit down. Well, old man Greed tapped on my shoulder. Limit down 10 days in a row. That's a lot of money. But I had a target in pork bellies. I went to bed that night. I had some few aches and pains from the marathon, but it was a head trip. He told me they're going to go lower, but I had a target, lower, lower. I said, you know what, Larry? Do what you tell people to do. Follow the rules. So I got out at my target. Bellies went down, hit the target, went lower for about 15 seconds, and then rallied straight up, and they never went down 10 cents until about 10 years later. So, you know what? If I have a profit, I'm really happy. I like to take profits. I'm in the business of taking profits. I'm not in the business of praying and hoping. If I got a little profit in here as a short-term trader, glory, hallelujah. Most traders I talk with and work with can't do that. Right here, if you buy it here, you're more than willing to take and make your profit right there. But once target trade gets there, you go, oh, I finally got a winning trade on. And you hold on to it too long, right? Yeah, you're probably, yeah, I do that. It's so unusual. We're the only business people that do that. If I had a store and I sell men's sweaters, and some guy comes in to buy my sweater and it's $150, and he says, yeah, I'd like that sweater. Do I say, well, it's $180 now? No, I go, oh man, I'm getting rid of this turkey, take it. But in trading business, we'll come in and say, well, pork bellies are at whatever price now. I go, well, no, that's not enough money. So I move my target. Oh, that's not enough money. Come to that target. We keep moving. That's not business. That's emotions. Not thinking here, that's saying, oh, I got a good trade on. I'm going to make more money. It's like, hey, you bought it to sell it. Is that right or wrong? That's right. You bought it to sell it. So if it gets to your target, sell it. Take your profit, live again for another. If you can get in and out of a trade, it's a remarkable experience. Enjoy it.
Are you using daily charts for both the short, intermediate, long-term swing?
I'm sorry?
Are you using daily charts for short?
I'm using daily charts to identify short, intermediate, and long-term trades.
All three?
Yep, all three from a daily chart. Yep, and I just love that, the target shooter. We have it in TradeStation. So TradeStation draws your line from here to here. It tells you there's your target, there's a target here. That's you can do it automatically. Or in the old days, of course, we just look at our chart and say, oh, we go to there, so the target's here. That's the way we used to do it. But I can't mark on the screens in the hotel rooms. They don't let me do that anymore. So there's the target shooter that I use for my intermediate term points in the marketplace.